You asked for it, you got it. Grab a cup of coffee and let's go over the agenda for what we're going to cover in this video. So my 6-step framework begins with the customer value proposition. How good of a value is this business offering its customers? It's a critical point I'd look for when I'm evaluating a business for investment. The second step is unit economics. Of course, it's easy to offer your customers a great value if you're willing to lose money on the bottom line. I could create a $1,000 product and sell it to you for $100 and you'd love my value, but the unit economics would be terrible and my business wouldn't be around for very long. The third step we'll cover is the total addressable market. What's the upside here? How much room does the company have to grow? The fourth step is competition. How is its competition affecting the company's market opportunity? And of course, with every investment, we have to consider risks. What are the downsides? What are the biggest downsides this company faces at the moment? And finally, valuation and the overall score on my 6-step framework. Of course, many of you have already read my book, and you'll know that each one of those 6 steps is a chapter in my book, a 6-step framework for evaluating publicly traded companies. The title of the book is Make Money Buying and Selling Stock. You can see in the table of contents, each one of those 6 steps I'm going to cover in this video is a chapter in my book. So let's start with the customer value proposition. And one of the ways I like to look at the customer value proposition is by looking at the company's revenue growth. This is especially true for companies where I can't personally experience their product. Some companies like Nvidia have products that sell to other businesses, and so it's difficult for me to evaluate their products personally. Whereas other companies like Netflix, I can experience their product personally, look at the price to value comparison, and compare with other streaming services and determine the customer value proposition. It's more difficult with companies like Nvidia to evaluate the customer value proposition. Still, you have to use what information you have at your disposal and make your investing decision. Of course, when you're less confident in the numbers and the research you've committed to, it creates an increasing level of risk for that investment, which we will incorporate into our framework for making investment decisions. Nvidia, its customer value proposition, looks excellent by the judgment of its revenue growth. Its revenue has increased from $6.9 billion in 2016 all the way up to $165 billion in the most recent trailing 12-month period. What's more, if we break this down into 2 different parts, pre-ChatGPT and post-ChatGPT, you can see the customer value proposition has accelerated meaningfully since the launch of ChatGPT, with its revenue growing from $27 billion in 2022 up to $165 billion in 2025. That's really how Nvidia has gained so much market capitalization in the last couple of years, is because of the launch of ChatGPT and the launch of large language models, including ChatGPT, Google Gemini, and others that are utilizing Nvidia's chips that go into these data centers to train these large language models and also help with the computing with the inference that comes out of these large language models. Remember, each search query that you conduct in a large language model requires multiples more computing power compared to if you put that search query in a traditional search engine. So since people are spending more time on large language models, the requirements for computing power are increasing exponentially. And so these companies that are purchasing Nvidia's products, which include Microsoft, Amazon, Alphabet, Meta Platforms, Oracle, etc., they're building these data centers to provide the computing power to support the growth of these large language models. So the end customer is OpenAI and ChatGPT, but they are not buying this directly from Nvidia. They're renting out the computing capacity from Microsoft and Alphabet and Amazon and others. And Google, with its large language model, is using its own computing power to deliver the necessary computing required to develop those models. Right now, That's the primary source of the growth of Nvidia's business and the primary use case for Nvidia's GPUs that are going into these data centers optimized for artificial intelligence. Another way I like to look at the customer value proposition is by determining and searching for the company's net promoter score. Nvidia boasts a net promoter score that ranks excellently. And so whether I look at the company's revenue growth or whether I look at the net promoter score, Nvidia scores excellently in the customer value proposition. And one final point I'll make about Nvidia's customer value proposition is that the company's products, its latest generation products, are almost completely sold out. Customers are waiting in line to receive their products. So we have 3 points of evidence to suggest that Nvidia's customer value proposition is excellent. So we'll get to the next step in our 6-step framework, which is unit economics. To measure unit economics, I use a variety of profit margins and metrics and ratios provided by the company or provided by the financial statements according to the company's numbers. And then you have data aggregators like I'm using here with Fiscal AI that brings together that information in a chart that's easy on the eyes. And Nvidia's gross profit margin at 69.8% is up from 58.8% in 2016. Now, for a company that's selling hardware, so primarily it's selling those accelerated GPUs that are going into these data centers optimized for artificial intelligence, a gross profit margin at 60% or above for a physical product is absolutely excellent. It's one of the best in class. Now, I will talk a lot about Nvidia's software ecosystem, the CUDA ecosystem that makes its GPUs so highly desired. We'll talk more about that a little bit later. But right here, for the unit economics, I'm going to focus on Nvidia as primarily a company that sells hardware products. And so a gross profit margin, absolutely excellent at 69.8%. Two things to note here. Not only is the 69.8% gross profit margin excellent, but it's also improving in the trend line. So increasing from 59% to 70%. So those are a couple of things I look at when I'm evaluating a company's gross profit margin. Is the absolute number, the trend, is it improving? And then finally, compared to other companies that are selling similar products, how is Nvidia's profit margin compare with those other companies? For instance, AMD's gross profit margin is in the mid 50% range, 50 to 55%. If I look at another company that's selling hardware like Apple, its product segment, its gross profit margins are closer to 35%. Just to put that into context, Nvidia's gross profit margin are well above those two companies that I just highlighted. So another way I look at a company's unit economics is by evaluating the operating profit margin. And so these are costs that come in below the gross profit. So in gross profit, you have revenue minus the cost of goods sold. But companies can manipulate the gross profit margin by spending more on items that are below the gross line item. For instance, if you're selling makeup and you want to generate a very high gross profit margin, you can sell your product at a high price that generates a high profit margin and then spend a lot of money on advertising and marketing that can support your higher price. And therefore, you'll generate a real high gross profit margin, but maybe your operating profit will be negative because you're spending a lot of money on advertising and marketing to support sales of your product. So you want to look at the operating profit margin as well as the gross profit margin to determine how strong the company's unit economics actually are, or if a management team is using some tactics to make its gross profit margin look better by spending more below that line item. And with Nvidia, it supports a very strong unit economic when we look at its operating profit margin that is at 58% in the most recent trailing 12-month period. And it's up from 28% in 2016. So not only is the absolute number excellent, but the trend line is also improving meaningfully. Furthermore, a operating profit margin of 58% I can compare this to all of Nvidia's competitors, and it will be well above their competitors. Not only that, this operating profit margin at 58% is better than nearly every company in the world. That's right, in the world. Out of the 300 companies that I'm following, there's only one company that has a better operating profit margin than Nvidia, and that's Visa. Its operating profit margin is about 65 to 67%. That's the only company that I follow, and I follow about 300 that has an operating margin above Nvidia's. So unit economics, check mark, absolute excellence for Nvidia. So the first two steps we looked at, Nvidia scores excellently across these two. One final check I like to do for the unit economics is looking at the return on invested capital. Nvidia boasts a return on invested capital of over 140%. Now, this number is so good that I don't think it's sustainable. Looking back at the last decade, Nvidia's return on invested capital has fluctuated between 25% and 140%. But most of the time, it's been above 40%. And the return on invested capital, the figure you want to compare it to is the company's weighted average cost of capital, which I calculate as part of my proprietary discounted cash flow valuation model, which I will share with you during step 6. And we'll look at this return on invested capital and compare it with Nvidia's weighted average cost of capital to determine how strong the ROIC to WACC ratio is. Now, I will tell you that Nvidia's return on invested capital, as I mentioned, is so strong, I don't think it's sustainable. But I do think that it can generate returns on invested capital at multiples of where its weighted average cost of capital currently is and is likely heading. And so I think measuring Nvidia on this metric, also Nvidia scores excellently on this regard. So now let's evaluate Nvidia's total addressable market. And the total addressable market is important for several reasons. For one, it highlights the upside for the company. We looked at the company's revenue figure at $165 billion. If the market where it's operating inside is a relatively small market, then this could be the ceiling for Nvidia because there wouldn't be much room for the company to grow its revenue above $165 billion. But if it's operating inside a market that's much larger, let's say it's operating inside a $1 trillion industry, then it's only 16% of the overall industry. And if the industry is expected to grow for several years, then there's room for Nvidia's revenue to continue growing. And so that's one of the main reasons why looking at the total addressable market is important. So right now, the most important market for Nvidia is the data center AI infrastructure market. Now, Nvidia operates inside a few other markets, including gaming and automotive, but its most important market right now in terms of size and in terms of the percentage of revenue that the company is generating is the data center market for artificial intelligence. Now, global AI infrastructure cost estimates suggest that the spending on this category could exceed $1 trillion by the mid-30s. Now, some other estimates suggest that it could reach in the many trillions of dollars by the mid-2030s. Now, the companies that are spending in this category include Amazon, Microsoft, Alphabet, Meta Platforms. Now, these are all companies that I follow on a regular basis, and I recently evaluated these companies' earnings reports and these companies' management teams. What they told investors for this year is that the budgets that they allocated was not large enough, and so they're increasing that by several billions of dollars, and they're also increasing their budgets for next year. And they've also all indicated that what they're seeing from their customers is that there is more orders than they have supply to fulfill those orders. So demand for this category is large and increasing, and the supply and demand balance is in favor of new demand coming on, a new supply coming online. And so that's the fundamental demand that's driving the growth of this market. And of course, it's the large language models right now and the artificial intelligence that enterprises are using, that's making every employee more productive, which is giving cost to these companies to spend money on artificial intelligence. So the infrastructure is one thing, but the chips that are going inside the infrastructure are another thing, right? There are many components that are going inside these data centers that are being optimized for artificial intelligence. But the primary component, the most lucrative component, is the chip, is the GPU. And this AI chip market is expected to continue a strong growth trajectory, and revenue for AI chips is projected to more than double between 2023 and 2027, reaching $119 billion by 2027. Furthermore, there are some estimates that suggest that AI could account for 80% of installed compute capacity by the end of the decade, up from roughly 40% in 2024. And Nvidia CEO Jensen Huang has been talking about how bullish he is about that trend specifically. He's been highlighting how these data centers right now that are in place, roughly $1 trillion worth of data centers that are not optimized for artificial intelligence, that are not primarily based on GPUs, that are primarily based on CPUs, that these data centers need to be upgraded and changed into being optimized for AI and being based on GPUs, because the total cost of ownership is lower. And so it makes sense for these owners of those data centers to upgrade them to the newer technology, because the total cost of ownership will actually decrease. And so that's the reason behind this estimate that 40% of compute capacity will increase to 80% for these data centers based on AI. As I mentioned, Nvidia operates inside the gaming market, which is not an exciting market for Nvidia stock investors to consider. It's becoming a smaller and smaller part of Nvidia's overall revenue. But the one category that I'm excited about for NVIDIA investors is automotive or autonomous vehicles, or visualization, you can call it, because this goes beyond driverless cars. This can be robotics, right? Because they operate on a similar technology as driverless cars. They're basically chunks of metal that are moving around by themselves. And so this category could be the next catalyst. And so the expectations are that the automotive autonomous vehicles are expected to see significant market penetration, with an optimistic forecast of 11 to 42% by 2035. And NVIDIA's platform is a leading solution for the technology that's powering these vehicles. So what I've been talking about with NVIDIA is, as the growth for those data centers optimized for AI starts to slow down, starting, I would say, 2030, that rate of increase is likely to slow down. The autonomous vehicle segment could be getting underway and accelerating and becoming the next catalyst to drive growth for NVIDIA. If you're bullish on driverless car technology, which I think a lot of investors are bullish on that, given the popularity of Tesla stock and the valuation it's commanding. If you think driverless cars are going to be all over the place, and if you think robots are going to proliferate, then NVIDIA is going to be a primary beneficiary of that trend. All right, so far we talked about the size and the growth rates of the markets where NVIDIA operates. Let's look at the market share. And so this way you can take a look at, where's the market going for this industry, and then look at NVIDIA's market share and kind of extrapolate what revenue will look like for NVIDIA looking ahead based on its current market share and the growth trajectory of the markets it's operating inside. So the data center market, NVIDIA commands an absolute lion's share of this industry. There's estimated 80 to 92% share of the total accelerator market. It has near monopoly status in the high-end training segment due to its CUDA software ecosystem. And we'll talk more about the software ecosystem. It's what really gives NVIDIA the competitive advantage inside these data centers optimized for AI. Sure, its hardware is also leading cutting edge, but it's the software ecosystem that's the real differentiator for NVIDIA gaining market share in this category. So in gaming, Nvidia holds a dominant position in desktop graphics, typically capturing 90 to 94% of the add-in board discrete GPU sales. It is the leader in this category, PC graphics, PC gaming. It's been the leader for decades. And then finally, you have the professional visualization and automotive market. And I combine these two together also because it's similar, right? You have chunks of metal being directed autonomously, and Nvidia is a leading provider in both of these specialized markets. It's had some key wins with automakers for its drive platform. And if driverless technology continues improving, which I do expect it will continue improving, I expect Nvidia will be a big winner in this category. So Nvidia is operating inside absolutely massive markets. The data centers optimized for AI is estimated to be between $1 trillion to a multi-trillion dollar market opportunity, increasing robustly expected over the next decade. And then to follow that up, you have Nvidia with the leadership position in visualization and automotive robotics, which is expected to grow meaningfully. It's a relatively small size right now, but it's expected to grow meaningfully over the next decade and probably accelerating after the year 2030 or so. It's going to take a few years for this technology to catch on with all the approvals and regulatory situations that need to be resolved, especially with driverless technology. And then it can kind of take off. All right, so now let's go into the next step in our analysis, which is competition. So Nvidia's competitive position is important because you want to know how likely it is that Nvidia will retain its dominant market share and hold that market share as the industry grows. Or will Nvidia slowly lose that market share? What's the primary factors keeping Nvidia's market share? And also, how are the companies in this industry competing? It's an important thing to know. As an investor, I absolutely despise investing in industries that are undertaking price competition or price wars. It's one of the reasons actually why I've avoided the electric vehicle industry altogether since 2020, 2021. And more recently, since 2022, it's been even worse. It's detrimental to investors when companies keep lowering prices and undercutting each other. It's good for customers, but investors lose because the profit margins keep getting smaller and smaller as you keep lowering your prices. And even if one of the companies wins this price competition, all of the companies end up wounded, and it's difficult to raise prices again after you've undertaken a price war. And let's say you beat your competition and all of your competition goes out of business and you want to raise prices again. It's difficult to do that because customers have gotten used to the lower prices. And if you try to raise prices, customers get upset and they buy fewer units of your product, or they substitute your product for something else because they get angry that you cut the price. Okay, so Nvidia's primary competition in the GPU space right now is AMD. AMD is the most potent challenger to Nvidia in this category, but it's still arguably at least one or two steps behind Nvidia. And most notably, it's because of the CUDA operating system, the software ecosystem that Nvidia boasts. That's the most formidable barrier to entry. It's not the hardware, but it's the software. This proprietary ecosystem has near universal developer adoption for AI and HPC workloads, and it's creating a powerful stickiness effect. NVIDIA has been investing in this CUDA technology since 2006, so it has a decades-long head start against AMD. Now, AMD is building out its own ecosystem. It's calling it ROCm. It's the direct open source attempt to compete, but it still lags significantly in maturity, stability, and broad-based library support, meaning switching costs for developers are still really high. But even if AMD were to make inroads with this ecosystem and make progress, it's not as bad as if these two were competing by AMD going to customers and saying, what's Nvidia charging you? We'll charge you 20% less. And then Nvidia coming back and lowering price, right? So it's a good thing that Nvidia's competition is trying to compete through innovation and not price competition. In that way, they can both carve out a niche for themselves in the market without hurting each other and battling each other through price wars. Okay, so maybe, and I fully expect AMD will grow to gain more market share. Nvidia will not retain a 90% market share in this category because, as I mentioned, the buyers of the technology, Amazon, Alphabet, Microsoft, will be uncomfortable directing such a large part of their purchases to one company and giving Nvidia that much negotiating power. Okay, so what are they doing about it? The hyperscalers. I mentioned those are Alphabet, Microsoft, and Amazon. Well, what they're doing to fight back, number one, is they're giving AMD an opportunity. They're telling AMD, like, go ahead, spend money on research and development and create this product because we'll buy it. Like, we'll buy at least some of it. We'll buy at least a few hundred millions worth, maybe a few billions worth of your product because we need an alternative to Nvidia. We don't want to give all of our business to Nvidia. That would give Nvidia too much power. And so AMD, you go ahead, do your thing. We'll commit to buying a certain percent of your product. And regardless if AMD's product is even comparable to Nvidia's, AMD will capture a meaningful market share. I'm saying at least 5 to 10%, I think AMD will capture. Another way these hyperscalers are fighting back is, I shouldn't say fighting back, but I should say protecting themselves, is by developing their own custom silicon. So Google is creating its TPUs, and these are optimized for massive scale training. AWS is developing two different chips, one for inferencing and one for training. They're calling it Inferentia and Trainium. These are tailored for inference and training and within the AWS ecosystem. In fact, when I evaluated Amazon's most recently completed earnings results, the management team told investors that these are selling out and the next production run for the next level, they're going to need to increase the manufacturing capacity and order more units of these custom silicon because they're selling out. They're doing really well. And Microsoft, of course, is doing its own designing chips for specific AI and general compute needs. Now, these aren't primary products for these hyperscalers. The primary product is Nvidia because the customers of these hyperscalers, they're looking for Nvidia chips because of these dominant competitive advantages I talked about with CUDA. But these are just, options just in case that Nvidia gets a little bit ahead of itself and starts to price their products way too high. These companies have a alternative they can go to and they can devote more investment towards if they see Nvidia, starting to increase prices maybe by too much, or if they see Nvidia is being more selective in the supply and not giving them enough supply of their GPUs. Because remember, we talked about Nvidia's GPUs are almost sold out for the latest generation technology. And if Nvidia starts telling these large hyperscalers, now, you know what, we're not going to send them to you, we're going to send them to some of our more preferred partners where we own a stake in the company, which Nvidia owns a stake in several of these kinds of companies that are using their chips designed for increasing the effectiveness of AI, then these hyperscalers can say, okay, let's accelerate our investments in our own product and let's boost the capacity, let's boost R&D, let's really dig into this because Nvidia is no longer an attractive supplier. Overall, looking at the score for Nvidia on competition, it's excellent, right? It's at least 1 or 2 steps ahead of the competition. It's got a proprietary software ecosystem with decades-long lead against anyone else. an early start against everyone else. And on top of that, the competitors are not competing against Nvidia on price, but they're competing against Nvidia on innovation. They're creating their own unique products and trying to carve out a niche in the market for themselves rather than providing a generalized product aimed at the entire market at a lower price that will hurt Nvidia's profit margins regardless. So now let's look at the fifth step, which is risks. All right. The first risk I'll highlight for Nvidia is that roughly 50% of its revenue comes from the large hyperscalers, including Amazon, Microsoft, Alphabet, and Meta platforms. So roughly half of their revenue is coming from these 3 or 4 companies. And that's a big risk for a couple of reasons. For one, if you have someone that's buying such a large quantity of your product, they could potentially exercise negotiating power against you and say, if you don't give us preferential treatment, we'll take our business elsewhere. Now, right now, that's not a problem for Nvidia because its product is so highly in demand that if these hyperscalers decide to decrease their purchases, Nvidia has others that are waiting in line that will buy its product. But that might not always be the case. The bigger risk right now is not from the bargaining power from these large hyperscalers, but it's the demand volatility. If these companies start to experience a decrease in their business, if they see their revenue falling, if they enter some kind of difficulty, then they might decrease their purchases with Nvidia. So let's say Amazon's business, they're impacted negatively by tariffs, right? So let's say those negatives are much worse than we anticipated, and Amazon experiences a big slowdown in revenue, a big decrease in profit, and a big decrease in cash flow. And in that scenario, Amazon might make the decision to slow down its investments on artificial intelligence. So rather than increasing, it might decrease its purchases of Nvidia chips. And just this year alone, Amazon, to begin the year, they said they were going to buy about $105 billion or spend about $105 billion on CapEx for AI. And then they increased that to $125 billion. But it could have went in the opposite direction, and they could have said, you know what, our business is under significant threat due to tariffs, and we're going to decrease our capex by 20 billion, 25 billion. That would be a big hit to Nvidia, a $20 billion decrease in capex. Remember, Nvidia's total revenue is 165 billion, and those 4 companies are 50%, so about 80 billion of Nvidia's revenue. So if they decrease their spending, if one of them decreases their spending by 20%, it will have a meaningful impact on Nvidia's business. Those billions of dollars will be a large part of Nvidia's overall business. So that's where I see the bigger risk here with the concentration of having its business focused on just these 4 customers, is that the volatility in their business could result in changing the orders for Nvidia chips. So the next risk I'm going to highlight is that Nvidia outsources its manufacturing. It doesn't manufacture any of its products in-house. And that's a strategy choice. That's a policy choice. And for Nvidia, it's becoming a risk now. It's becoming a major risk now because it outsources its manufacturing to several partners. But Taiwan Semiconductor Manufacturing Company is the most critical, in my opinion, partner for Nvidia. And Nvidia is growing to rely on Taiwan Semiconductor significantly. So that's a concentration risk to a supplier. And so the risks there is that Taiwan Semiconductor might tell Nvidia, look, and Taiwan Semiconductor serves other large companies, including Apple, AMD, and Intel. And Taiwan Semiconductor might go to Nvidia and say, we don't have space to produce your chips. We don't have the capacity. We can only provide you with this much in production this year. But Nvidia might need more, and it can't produce more because there is no viable alternative to Taiwan Semiconductor Manufacturing Company right now. Now, there are some companies that are investing to try and be that alternative, including Intel, which has spent tens of billions of dollars, and Nvidia is working with Intel. You can understand why, now that we looked at the company's risks, Nvidia is working to lower its risk, to lower its dependence on Taiwan semiconductor manufacturing, and that's why Nvidia is really rooting for the success of Intel in the same way that Amazon, Microsoft, and Alphabet are rooting for the success of AMD to offset that concentration risk to Nvidia. Nvidia is in the same way rooting for the success of Intel to offset the concentration risk at TSMC. Regardless, this risk will persist for some time because Intel is not yet ready to be that alternative to Nvidia. So this is a significant risk for Nvidia. And then to top that off, that risk is more eminent because Taiwan Semiconductor Manufacturing, most of its manufacturing facility is based outside of the United States, even though it is investing in the United States right now. Most of it is outside the United States, and the current administration is highly against U.S. companies importing products from outside the United States. They're undertaking several measures to try and reduce that activity, including tariffs and other kinds of trade barriers and punishments to try and stop this action of U.S. companies importing products from outside the United States. So these are the two primary risks I see with Nvidia right now. All right, you've stuck around this long. You truly are a dedicated investor. Let's get to valuation. So I conduct my own proprietary discounted cash flow valuations, which forecast the company's free cash flow out roughly a decade and discount those cash flows back to the present to determine a present value for the stock, what I believe the stock is worth today, right now. And I've done that with Nvidia. So my free cash flow estimates suggest that Nvidia's free cash flow will grow from an estimated $97 billion in fiscal year 2026 all the way up to $800 billion in fiscal year 2035. So I'm forecasting that Nvidia's cash flow will grow by roughly 8x between now and 2035. Now, this figure looked very large to me. When I'm looking at it, $808 billion, that looks very large. Does that make sense? Is that possible? So let me go back and look at the company's revenue. So Nvidia generated $165 billion in revenue. That was about more than 20, I would say 25 times the revenue it generated in 2016. So can Nvidia's revenue increase by that much between now and then? And also, I need another figure. I need the company's cash flow to sales. I need to know how much its sales turn into cash flow. So for that, I look at the company's operating cash flow to sales ratio. And this is an accurate estimate of Nvidia's free cash flow because Nvidia, as I mentioned, it outsources its manufacturing, so it doesn't need to spend all that much money on capital expenditures. And so we can look at the cash flow to sales ratio to determine and forecast its cash flow. And its operating cash flow to sales ratio has been rising from 24 to 46%, so it's nearly doubled, and 46% of sales. Okay, so what we need then, if we estimate, let's say rough estimate, back of the envelope, that Nvidia will generate 50% of operating cash flow to sales by 2035. Let's say this margin continues improving ever so slightly and increases to 50%. So that means that in order for Nvidia to generate $800 billion in free cash flow in 2035, that it needs to generate $1.6 trillion in revenue in 2035. Is that plausible? Let's find out. So revenue of $165 billion in 2025, which was up by more than 25x in the previous decade. And in order to get to 1.6 trillion, it needs to go roughly 10x from here. So in the previous decade, it increased by more than 20x. In the next decade, it needs to increase by 10x. And I think that's a reasonable assumption to make here with Nvidia, given the markets it's operating inside. We looked at the total addressable market for the data center optimized for AI, how it's going to be $1 trillion up to multi-trillion dollar category. And then following right behind that is the driverless technology, robotics industry that's likely to grow to become hundreds of billions of dollars, perhaps trillions of dollars in market size, total addressable market by 2035. And if Nvidia still maintains its leadership position in that category, as well as a leadership position in the data center category, then it's reasonable to assume that Nvidia could capture that kind of revenue to justify an $800 billion free cash flow estimate in 2035. Of course, this is a risky assumption to make, right? We're looking a decade in the future and we're assuming a lot of things. And so we incorporate that in our valuation, and that's incorporated in the weighted average cost of capital of 13.6%. That's the rate at which I'm discounting all of these cash flows back to today. And the weighted average cost of capital contains a mix of debt and equity. Now, debt is relatively low cost for Nvidia because the company generates so much cash flow and it has so little debt compared to its overall equity that it's not a big risk for lenders. It's a bigger risk for investors, but not for equity investors, but not for lenders. And that's reflected in its cost of equity, which I calculate using the capital asset pricing model. The capital asset pricing model is equal to the risk-free rate, which I take the 10-year US government bond as the risk-free rate. So that's 4% right now. And you add to that a company's beta multiplied by the market risk premium. So the market risk premium I estimate at 5.75%. And Nvidia's beta, this can be observed if you have Yahoo Finance or if you have Google Sheets. You can use the formula equals Google Finance, open parentheses, Nvidia, comma, and then beta, and you put those in parentheses. If my editor can show this top part here, you can see the formula I embed into my discounted cash flow valuation model to retrieve the beta, and then this updates automatically as Nvidia's beta changes. This beta here changes. So when you combine those, right, the risk-free rate plus the market risk premium times the beta, you get a cost of equity at 16.1325% for Nvidia. And you can see that's more than 2 times larger than its cost of debt. And you can understand why that I'm estimating Nvidia's capital structure will become more geared towards debt in future years. Nvidia will borrow more and more money, not because it needs it, but because the cost of debt is so much lower than the cost of equity. And if you want any evidence of that, you could see last week, Alphabet borrowed $25 billion and Meta Platforms borrowed $30 billion because they're in a similar situation. They have relatively low debt to equity and their cost of equity is so much higher than the cost of debt. So they both borrowed the tens of billions of dollars to better balance their capital structure to decrease the weighted average cost of capital because they understand that investors like myself are using that to discount their future cash flow and create a fair value calculation for their stock. So once we evaluate those cash flows, discount them back to today, their value of operations is over $4.7 trillion. That's the present value of all of the free cash flow I expect Nvidia will generate between today and the very, very long run, even beyond 2035. Because it's not like it's going to stop earning free cash flow by 2035, but that's the end point of my free cash flow estimates. From that point on, I calculate a terminal value for Nvidia stock, which takes the 2035 cash flow divided by the expected growth rate, which I give the company an expected growth rate in the long run at 5%, subtracted by the weighted average cost of capital, and flip those two. It's the weighted average cost of capital subtracted by the growth rate in the denominator. So in the numerator, you have this 2035 cash flow. In the denominator, you have the weighted average cost of capital minus the long-term growth rate, so 0.1360 minus 0.05, and you get this terminal value of 9.4 trillion. This is the value of all of the cash flow I expect Nvidia will generate between 2035 and forever. And forever. So I bring all of those cash flows back to this point in time, and then I discount from this point in time back to today. And that's what's all included in my value of operations calculation. And to that total, you add some non-operating assets and debt, which almost cancel each other out. And I arrive at the value of equity of 4.75 trillion. And then I divide that by the number of shares outstanding, which are 24.3 billion, I should say, for Nvidia, which brings me to my intrinsic value per share calculation at $195 compared to the current market price of $189. Now, when the valuation is this close to the market price, I don't say it's undervalued. I say it's fairly valued. And for companies like Nvidia with a higher beta and higher risk, I tend to have a larger margin of safety, closer to 10 or 15% margin of safety, before I will say that the stock is undervalued based on my discounted cash flow valuation model. So based on this, I would say that Nvidia stock is fairly valued based on my discounted cash flow valuation. But I also like to look at valuation on a market multiples basis. So these are your forward PE ratio, your forward price to OCF ratios. And with Nvidia, it's trading at a forward PE of 34 and a forward price to cash flow of 37. Now, given Nvidia's growth, its profit margins, its return on invested capital, which remember, we talked about we wanted to compare the return on invested capital to the WACC. Nvidia at 142% compared to the compared to the weighted average cost of capital of 13.6%. It has a ROIC to WACC ratio of more than 10 to 1. More than 10 to 1. That's maybe the best out of any company that I'm following, and by far. Okay, so as I mentioned, I don't think that's sustainable. But as of right now, it's absolutely excellent. It's off the charts. It's incredible. And so to have a company with this kind of growth, with this kind of opportunity, this kind of competitive advantage, to be selling at a forward PE ratio of 34 and a forward price to free cash flow of 37, I think it's undervalued based on the market multiples method. So combined, the market multiples with my DCF, you get a bit of a mixed picture with Nvidia. I can't clearly and comfortably say that the stock is undervalued based on these prices. All right, so you've made it through all 6 steps of my framework. Congratulations. Now let's look at the actual score. So in my book, right, if you read my book, if you go all the way to the end, towards the end here, page 60 out of 64, I give you the factor weightings, right? So I have 6 steps, but I don't consider each of the 6 steps equally. I weigh them differently because some of the steps are more important than others. And for me, the valuation step is the most important step, because you can have a great business, but if it's selling at a price that's too expensive, you don't really like that value, right? It's similar to like you go to the store and you see some great product, you love the product, and then you look at the price and you say, it's not worth it. The product is great on everything else except the price, and that is everything, right? You won't make the purchase even though everything else checks every box, but the price is too expensive. So price is extremely important. I weighed 40%. All right, so the customer value proposition. We talked about how Nvidia was excellent in that regard. I give Nvidia a score of 100 out of 100 on the customer value proposition. Unit economics, Nvidia also scores 100 out of 100 in unit economics. Gross profit margin, operating profit margin, return on invested capital, OCF to sales, almost best in class in all of those categories, not just against its competition, but against nearly every company, right? So excellent score in unit economics. Total addressable market, it's operating inside the massive data centers optimized for AI that's growing significantly. And it's also operating inside another innovative category in automotive and driverless car technology and robotics and visualization, which is not yet a big industry, but is growing meaningfully and is poised to become a big industry with potentially trillions of dollars in revenue generated from these technologies, where Nvidia gains and has a leadership position. So it scores 100 out of 100 in the total addressable market. Competition is very strong for Nvidia, not as strong as in the other categories. It's arguably 2 steps ahead of the competition, and competition is not undertaking price cutting. They're trying to gain market share. They're trying to carve out a niche for themselves, and they're just trying to protect themselves. The hyperscalers are just trying to protect themselves with their own products, and then AMD is trying to carve out a niche for itself. And so competition, I like the position that Nvidia is in regards to its competition. It scores a 95 in that regard. Risks are where Nvidia scores very low. The lowest out of any of its three, it gets a 73 on risk. The two biggest risks I highlighted, the concentration risk to those hyperscalers. If there should be slowdowns in their business, these hyperscalers could easily cut their spending by each $50 billion or $75 billion each, right? And that would be devastating to Nvidia's revenue in the short term until it finds other customers to replace that demand. It will need to find many, many, many smaller customers to make up for the lost revenue if these hyperscalers should enter into a period of business difficulty that will lead them to cut down their spending. And then on top of that, you have the risks from its concentration in manufacturing to Taiwan Semiconductor and the geopolitical tension surrounding the U.S. increasing trade barriers against businesses that are importing products. So Nvidia scores only 73 on the risk, which is a 15% weighting in my algorithm. And then valuation, we looked at how in my proprietary DCF valuation, Nvidia stock looked fairly valued, right? The intrinsic value was a little bit below the market price, but not by all that much. And if we account for a margin of safety there, it's not all that much undervalued. But then we looked at the market multiples, and it did look very attractive on the market multiples based on all of these other factors you look at. And then you look at the market multiple, I would be willing to pay a higher market multiple compared to what I'm able to go out and purchase Nvidia stock for. So total score for Nvidia on my 6-step framework, 91.5. It earns an A. It earns the spot. I own Nvidia stock myself. I bought it for my own portfolio at about $90 a share. And I've rated Nvidia stock as a buy as one of the best 6 stocks to buy right now. And I updated that recommendation on November 3rd. By the way, this discounted cash flow valuation model and many, many more is available to channel members at the investor tier. You can see here all the selection of companies I have a discounted cash flow valuation for. So you could just click on these hyperlinks and it'll take you to my discounted cash flow valuation for that specific company. And I have formulas embedded in these calculations and they update automatically. And then I also go in manually. Every day I'm updating these for several companies. But at the investor tier, you also get access to this spreadsheet, which holds my buy, hold, or sell ratings on hundreds of companies and the price target for many of the companies as well. So this is at the investor tier. You get access to all of this stuff. So overall, Nvidia, a great business to own at the current market prices, a risky business to be sure, as you can see, very high risk based on the low score it earns on its risk profile. Thank you again for sticking around so long to watch this long video. And thank you again to my channel members that voted to have Nvidia stock as one of the videos I create this week. Remember, this vote was conducted last week. This week, my channel members are voting on what videos I will create next week. So thank you again for being a channel member, and join if you're interested. Click that join button. See all of the excellent benefits you get for joining our channel. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.